Welcome to another tutorial video. In this one, we're going to be taking a break from some of the valuation and DCF topics that we've covered quite a bit over the past year, and I want to cover some other topics such as mergers, acquisitions, M&A deals, and M&A analysis, and we're going to be taking a look at something called the value creation analysis here, and going through an accompanying Excel file with some calculations about how to set up this analysis and what it can actually tell you. So one common question we get about M&A deals is, why is there so much focus on EPS, earnings per share, accretion, dilution, to evaluate M&A deals? Aren't EPS and net income flawed metrics for reasons that you've explained previously? Aren't there other ways to evaluate deals that might be more accurate or useful? And the short answer to all this is yes, there are many other ways to evaluate M&A deals. You have the contribution analysis, you have something called the has-gets analysis, and then there's something called the value creation analysis as well. Now, all these are related in some way because they're based effectively on the financial metrics that the buyer and seller contribute to the combined entity, and then you make various adjustments and try to draw conclusions about the purchase price and the merits of the deal from that, but we're going to focus on the value creation analysis here. People focus on EPS accretion dilution because it's easy to use in interview questions, and it's also quite easy to understand because pretty much everyone knows what EPS is, net income divided by the company's share count. But EPS accretion dilution also has some limitations, especially if it's a 100% stock deal where the buyer doesn't necessarily care about what will happen to its EPS a year or two after the deal, but they do care a lot about how they'll be valued as a combined company after the deal takes place. Will their shareholders actually get higher share prices? Will their trading multiples go up or down after the deal closes? In a lot of these 100% stock deals, especially between companies of similar sizes, the focus is on valuation, not necessarily on EPS accretion dilution. In these cases, the value creation analysis can be a helpful supplement for normal EPS accretion dilution. You're almost always going to look at EPS in any M&A deal, but these other analyses, like the value creation one, can be a very useful additional analysis to look at. So here's the basic idea behind how it works. Once I explain this, then we'll go into Excel and go through the step-by-step process, and I'll show you what the calculations look like. Value creation could refer to a lot of different analyses in leverage buyouts and LBO modeling. It could refer to standalone operating models, but we're going to focus on the one specifically for M&A deals here. So here's the idea. Let's say that you have a buyer with $1,000 of EBITDA, and the buyer has a 10x EBITDA multiple. So the buyer's enterprise value, therefore, is $10,000. And then you have a seller with $500 of EBITDA, a 12x EBITDA multiple, and so its enterprise value is $6,000. If you combine the EBITDA from the buyer and seller, it's $1,500 if you ignore synergies, acquisition costs, and so on. But then for the combined multiple, what if rather than the combined company trading at a 10x or 12x multiple, what if it actually trades at a 14x EBITDA multiple? In that case, if you take the 14 times EBITDA multiple and you multiply by the combined EBITDA of $1,500, the combined enterprise value would actually be $21,000. So it wouldn't just be the $10,000 plus the $6,000 here, and we're assuming no premium paid for the seller, but if you add these up and assume that the combined company trades at a higher multiple, the combined enterprise value would exceed the buyer enterprise value plus the seller enterprise value. The justification for this higher multiple is usually that the combined company will more closely resemble another bigger company in the market that actually trades at around 14 times EBITDA or some other higher multiple. If there are synergies, the combined enterprise value could be even higher than that because the combined EBITDA will be higher as a result of these synergies. And so what this means is that the buyer's shareholders could get more than they expect because now their shares will increase in value after the deal closes. So they're not just going to get this other company and all the financial contributions from the other company, but they could actually get higher prices for their shares as a direct result of the combined company trading at this higher multiple, this 14x EBITDA. Of course, this analysis is also quite speculative because there's no guarantee that this combined company will magically start trading at a higher multiple after the deal closes. Maybe the buyer and seller think that they resemble this other bigger company in the market, but the market disagrees. And so maybe the combined company actually just trades at a normal 10 or 12x EBITDA multiple, the same as the standalone companies. Now that we've been through the basic concept, let's go through the calculations in Excel so I can show you exactly where this comes from and how to set this up and how to draw some quick conclusions. So the first step here is to pull in financial metrics for the buyer and seller, and also the deal metrics like the purchase price, the cash, debt, and stock used to fund the deal, all of that. So in this case, I've already pulled in the metrics for the buyer and seller here. For Builders First Source, the buyer, and the seller, BMC Stock Holdings. This is an actual deal from a couple years ago. And if you go over, I have pulled in their revenue and EBITDA on a historical and projected basis, and I filled in some of the numbers for the revenue growth and the EBITDA growth and all of that. So all this is already here. If you go up to the top, you can see where I've calculated the implied offer price for the seller. This deal is based on an exchange ratio, which we've covered elsewhere. But essentially what this comes down to is that the buyer paid a very modest premium for the seller here. We need to calculate the cash, debt, and stock used to fund this deal. And I'm going to ignore fees and other more advanced items here and just base this on the purchase equity value. So we'll take the percent cash used multiplied by the purchase equity value, copy this formula down. And for the stock used here, we're just doing 1 minus the cash used and the debt used. Those are both percentages to get the percent stock used. For the new shares issued, we just take the dollar value of the stock issued and we divide by the buyer's share price right there. And we'll need all this later on in the analysis. But long story short is that we have the financial metrics for the buyer and seller. We have the deal metrics. We know how much they're paying, and we know the cash, debt, and stock used to fund the deal, as well as the new shares that will be issued in this deal. Now, the next step is that we need to find a similar but larger company in the market that trades at higher multiples. And in this case, once again, I've already done this work. We have these two companies, Carrier Global and then WW Grainger. You can see that they're both quite a bit larger, around 10 times larger than Builders First Source or BMC Stock Holdings. If you look at the equity value, the enterprise value, and you also just look at the company's revenue and EBITDA numbers, based on those, they're not exactly 10 times larger, but it's clear that they are significantly larger. And if you go down here more significantly, if you just do a quick comparison of the valuation multiples here, our two companies are trading at revenue multiples of around 0.5 to 0.6x. These two companies are trading at more like 2x revenue. And then if you look at it on an EBITDA multiple basis, our companies are in the 8 to 9x range, and these companies are more like 13x to 15x. So we have these two larger companies in the market that are indeed trading at higher multiples. The next step here is to combine the buyer and seller's financial metrics and adjust for synergies and acquisition and integration costs. So this is pretty simple. For the revenue, we are just going to add up the revenue from both these companies on a historical and projected basis, and then we'll factor in the synergies and other adjustments. These come from a separate schedule that we've already calculated elsewhere. And you can see we do get some revenue synergies in the second projected year here after the deal closes. We don't get any in year one because it takes some time to actually integrate the companies and to realize these synergies and so on. So we're not factoring in anything there. And then for EBITDA, we can do pretty much the same thing. We can just take these and add up the individual EBITDA numbers and then factor in some synergies in year two. We do get a lot of revenue synergies. Hardly anything flows down to EBITDA though, presumably because we are still paying for some of those acquisition and integration costs at this point. And then we could also fill in the debt to LTM EBITDA here just for our reference. So for this part, we can just go up and sum up the debt for the individual companies right here. And then we will take the debt that's issued to fund this deal, and then we can divide by the combined LTM EBITDA right here. And so now we can see that if you want to look at it like this, yes, the combined companies have a little bit more debt, and in that way, they're also closer to these two larger companies in the market. So we have our financial metrics for the combined entity. Step 4 is to apply the multiples of the similar but larger company to these combined financial metrics. So let's go down and do that. You can see right here we have this line, combined entity post-transaction and acquisition effects. And so there are a couple ways we could do this, but since we have two companies here, I think the easiest method is to take an average of these multiples. So let's take an average in each year, copy this across. And now we can calculate the company's implied enterprise value. So the implied enterprise value for this combined entity. To do this, we'll take these multiples, the higher multiples here, and then multiply by the revenue and EBITDA for this combined company. Take this and copy it across. And so we have that. And of course, this is useful. It tells us something because we know that it's more complicated than just taking the buyer's enterprise value and then adding the purchase enterprise value for the seller. This would give us a combined enterprise value of about 7.1 billion, but actually, if you use these higher multiples, we get much higher numbers, over 20 billion for revenue multiples and more like 11 to 12 billion if we base it on these higher EBITDA multiples from these two larger companies instead. Now, the next step here is that we need to back into the combined company's implied equity value and implied share price, and we need to factor in the debt and the cash from each company separately, as well as the debt and the cash that are used to fund the deal. I'm highlighting this here because it's very easy to forget this step of the process, and it's a common mistake in this analysis. But if you want to look at this as a combined entity, you have to include the fact that the capital structure changes as well. We have the company's separate financial metrics up above. So for the cash and cash equivalents, let's just go up and add them right here. Since we're going from enterprise value to equity value, we actually want to flip the sign on the cash and the equity investments and non-core assets and the debt and the preferred stock. So with all of these, I'm going to enter this summation. I'll flip the sign on it, and then we'll go up. And since we are using some cash to fund this deal right up here, it means that our combined cash balance is going to be lower. So it's not just going to be the 385 plus the 253 here. We actually have to subtract the 377 million of cash that is being used to fund this deal. So let's do that. And then for the equity investments and non-core assets, this is not going to change in the deal. So we can just go up here and sum up the non-core assets and flip the sign on this one. And then for the debt, this is going to change in the deal. Let's go up first and do a sum of the company's debt separately. We're assuming that the target's debt just stays the same in this deal for now. It could be paid off, it could change, but we're just keeping it simple and assuming that the dollar amount of debt remains the same after the deal closes. So we have that. Let's just fix the anchoring there. And then let's go up, and we need to factor in the debt that's used to fund this deal. And I should actually be subtracting this because we want negative signs on this debt. I'll also anchor this. We have that. And then finally, for the preferred stock, we're not funding this deal with preferred stock at all. So I'm just going to do a summation. Let's go up here and take this. And we should also flip the sign on this one. And I want to anchor this as well. Then we can add up everything here to get to our implied equity value. And we can copy that across. And it looks like I messed up the anchoring here because we're getting really weird numbers. So let's just fix that quickly. We want all these numbers to be the same going all the way across because it shouldn't matter what the combined multiple is. The capital structure changes in the same way regardless of what our assigned multiple here is. So these are our implied equity values. Now for the diluted share count, the combined diluted share count, we want to take the buyer's diluted share count up here, and then we need to add the new shares that were issued to do this deal. So let's take both those. And then to get to the implied share price, we just take our implied equity value and divide by this diluted share count. Now the buyer's share price just before this deal announcement is shown up here. So it was around $27.91. Let's link to that. And then for the per share value created, we take our implied share price after the deal closes and after the company starts trading at this higher multiple, and then we subtract the buyer's share price from before the deal was announced, right down here. We can also look at the per share value of the equity purchase premium to see if the premium that the buyer is paying is actually worth it. And to do this, we can go up and take the offer price per share. We can subtract the target's share price right here, the seller's share price. And then we can multiply by the target's diluted shares right down here. And then we can divide by the diluted share count for the entire company. So this is essentially taking the premium and then dividing it by the total share count for the whole company to see if the buyer's shareholders, which this new higher share count represents, are actually getting something for the premium that the company is paying. So let's take this and copy this across. And so we have that. That was actually step 6. We calculated the combined share price and compared it to the buyer's current share price to see if value was created. Now we can go in and create some graphs and sensitivities to justify the argument and make these claims seem more realistic. And so down here, you can see what I've done. I've already set up some sensitivity tables here, essentially showing us that if this combined company trades at anything higher than their current multiples of about 7 to 9x or 7 to 8x enterprise value to EBITDA, then we should get at least some amount of value creation. Now, if they keep trading at their current multiples, then we might actually lose value in this deal. If you look at the numbers here, we get to a negative number. If there's a very high amount of synergies created in year 2 and they boost EBITDA significantly, so let's say 100 million in synergies, then in that case, we don't necessarily need a higher combined multiple. So we don't need to be trading in the 12x, 13x, 14x range that these 2 other bigger companies in the market are trading at. But bottom line is what it tells us is that we need to get a multiple here that is at least somewhat higher, or we need to get quite a bit more in synergies than what we've assumed. And then you could go over and you could come up with these other graphs. For example, this one about showing the buyer's standalone share price versus the combined entity's share price. You can see here that it looks very good if you base it on this graph. And then if you go up to the top, you can see our justification. We're saying that the dark green here, the company in dark green, the combined financial metrics for the buyer and seller allegedly more closely resemble these bigger companies in the market. Although, as you can see, it's a little bit of a stretched argument because we're still quite far apart from these other companies. The bottom line, though, is that the overall conclusion here is that even if we're remotely correct, we think that this Builders First Source BMC stock holdings deal should create value, because even with multiples that are slightly higher or slightly more in synergies than we expect, then the share price of the combined company should go up according to our analysis after the deal closes. In the last part here, I want to go through when value creation is actually useful or at least plausible. The truth is that value creation is a much more specialized analysis that is generally most useful in specific industries like real estate investment trusts, REITs, but tends to be less useful for most normal companies. With real estate investment trusts, they're essentially collections of individual properties. And so if 2 REITs combine to gain scale or to expand geographically, they could actually resemble a much larger REIT in the market, and they could legitimately trade at higher multiples because they span a much greater geography. They're earning more revenue from more diverse industries, and so there's a legitimate reason for them to trade at a higher multiple. With normal companies, it's much harder to say this because even if 2 companies in a similar industry combine, the market is not necessarily going to value them the same way that they value a larger company in that industry. Normal companies are more different, and they're not just collections of individual assets. If you look at some of the presentations that I've linked to here, you can see this rationale used in a lot of REIT mergers, where these 2 companies combine, they'll list them on a graph, and then they'll make the point that on a pro forma basis, they are now much closer to a larger company in the market. And so this type of argument is used with REIT merger models all the time. I have another example here for the acquisition of Pinnacle Entertainment's real estate assets. And in this presentation, if you go down a little bit, they actually mention value creation several times. And they don't set it up exactly the same way that we do here, but it's a pretty similar idea where they take these 2 companies, they combine them, they assume a higher multiple, and then they say, look at this, our shareholders, the shareholders of the buyer, will get a 30% increase because of the fact that now we're bigger and now we might trade at a higher multiple as well. So this tends to be most common for REITs, though you can see it for normal companies in some cases. The other problem with applying this to normal companies, though, is that bigger isn't necessarily better. Valuation multiples depend on growth rates, margins, the discount rate, and a lot of company-specific factors as well. So the value creation analysis can be useful, especially if you are working on a 100% stock deal in a market where companies' scale and their multiples actually correlate pretty well. But it is a lot more speculative than EPS accretion dilution, and I would argue it's actually better for assessing the potential downside to shareholders. So for example, what if the combined multiple is the same or lower? If we go in and make that adjustment in this analysis, for example, let's say that we go in and we assume that the combined multiple is not an average of the multiples of these two much larger companies, but it's actually an average of our buyer and seller's standalone multiples. If we do that, we can see that actually some value is destroyed in this deal. We get to negative values over here for the per share value created, because if there is no multiple expansion here, if this combined entity just trades at the same multiples, it's not so great a deal for the buyer shareholders. And of course, if we go lower, let's say that it trades at slightly lower multiples. Let's adjust down the revenue multiple here, and let's adjust down the EBITDA multiples as well. Now we get even more value lost in the deal. So value could also be easily destroyed, and that's something else that this analysis tells you. We're at the end, so let's do a quick recap and summary. In a value creation analysis, you assume that two companies combine and then trade at higher multiples than either company did as a standalone entity. The justification normally is that these two companies together resemble another bigger company in the market that trades at higher multiples. The value creation analysis is most useful for assessing M&A deals involving equity REITs or other companies that are effectively just collections of assets and where greater scale and geographic diversity and industry diversity can actually correspond to higher multiples. With normal companies, you will sometimes see bankers using the value creation analysis to justify deals, but it's a little bit questionable unless the deal really fits the purpose of the analysis. If you're a shareholder or an investor, you could use this analysis to assess the potential downside risk of M&A deals as well, and that's probably the more realistic way to think about and use this analysis when looking at mergers and acquisitions. That's it for this tutorial. Hopefully now you know a little bit more about these alternative ways to assess deals and at least how to set up and execute the value creation analysis.